All right. Well, welcome to tonight's webinar, The Fundamentals of Precious Metals Investing. This is a very special webinar, plus an introduction to diamonds. And we're, of course, referring to diamond investing. My name is Jerry Robinson, the founder and editor-in-chief over at Follow the Money Daily. That's FTMDaily.com. And I'm also joined, there's my long bio, which you can read perhaps if you pause this in the recorded version. And then there's also, I'm being joined tonight by my good friend and veteran precious metals advisor who you hear on the radio show all the time. Every single week he joins me, my good friend Tom Cloud, joining us from right around Jekyll Island, St. Simon's Island, where he lives down in Georgia. Hey, Tom.
Hey, Jerry. Great to be here.
People always get a kick knowing that you live right down there off of Jekyll Island where the Federal Reserve was born back in 1913.
Yeah, I played golf over there this weekend for the first time ever and went right by the place. They've refurbished it, and it's looking grand in its refurbishment, but it brings back a lot of memories from reading The Creature of Jekyll Island.
Oh, yeah. Well, that's where he is, kind of fitting for a for a gold dealer who's been in the business since 1977. And Tom is a guy who I turn to when it comes to precious metals, hard assets in general. He is going to be talking tonight about gold, silver, and also, as I mentioned, diamonds. We're going to begin, though, by reminding everyone that we have our 5 levels of financial freedom here at our organization. The 5 levels of financial freedom, basically helping you help yourself, helping you motivate yourself, get to the place you want to be financially free. There is hope, friends. If you're in a place right now where you're feeling like you are stuck in a dead-end job, or you're feeling as if there's simply no way to financial freedom and spiritual freedom is what we are all about here at our organization. And we lay out 5 levels tonight, just for those of you who are going through our 5 levels, which there are so many of you, and you constantly email me and tell me your success stories. Tonight we're talking about, in particular, level 3 and level 4, building the diversified liquid savings at DSL, at 6 months liquid savings. We're going to be using some gold and silver for that, and also for investing purposes, gold, silver, and even tonight a new, and some would say exotic investment. It's certainly not something that we typically think of when we think about investing, and that is diamonds. And so we're going to move into all that. First of all, we need to lay out the fact that Western economies are in trouble. You know, Tom, when I started this message so long ago, I remember I used to have to really try to convince people that there was a problem. In fact, even my publisher with the book Bankruptcy of Our Nation, I had to try to convince them that the book should be called The Bankruptcy of America. And they didn't want to call it that. They wanted to call it A Bankruptcy of Our Nation. They thought it would be over the top. Now, you know, the polemics and the hyperbole is just out of control. Everyone's talking about how backwards the nation is and how it's the death of America and the bankruptcy of America. And you know, it's really astounding how fast and far we've come just over the last 18 months in the public conscience. Wouldn't you agree, Tom?
Oh, absolutely. I mean, you look at it, I've never seen a bigger change in the last 5 years. And like you said, when you're talking to people about investing, they don't want to let loose of the golden years market from 1981 to 1999. But unfortunately, we don't live in those times anymore. The system has been abused by fiat currency, by politicians buying votes, and by politicians giving away a lot of our money to buy votes. And now it's gotten to a position where it can't be turned around without, in my opinion, some kind of currency tied to gold that the whole world respects. And certainly we don't have that right now.
You know, if you look at the screen right now, friends, it says Western economies like the United States and Europe are currently faced with gargantuan debt loads, which I don't think anyone would debate, as a result of unwise fiscal policies. Okay, fiscal policies are those created in the Congress. Those are the things made by Washington and the politicians, and that have been aggravated by poor monetary policies. And those, of course, are the ones that are emitted from the central bank, from the Federal Reserve. So we have very poor fiscal policies being issued from the Senate, from the White House, from the Congress. And then, of course, coupled with that, we have very poor monetary policies, which are things such as interest rate targets and all of this that we've seen from the Federal Reserve, the keeping interest rates low, the bond buying programs, the QE2s, all of this. Very poor monetary policies that have led us to where we are. Governments are in deep debt. Consumers are reluctant to spend. Businesses are afraid to hire. Housing prices are still in decline in some areas. So we certainly see a problem. And then, of course, in the emerging economies, they're faring better. It's not as if they are just completely insulated entirely from all of this, but they are certainly faring better. Many of the emerging economies like Brazil, Russia, India, China, and many others have lighter debt loads. They're experiencing booming economic growth numbers, some near 10%, some over 10% per year. The rise of a new middle class in these areas is lessening the dependence upon Western consumption. So for a long time, the consumers here in the United States, the consumers in Europe, really fed these emerging economies, but now they're beginning to formulate their own middle class. They're beginning to develop their own working class, and the working class obviously needs to consume, and they want to buy clothes, and they want to buy vehicles, and they want to buy meat, and they're beginning to carve out their own middle class and their own consumption class, and this means that they're becoming less and less dependent upon Western economies. So where we are right now, we have to ask the question. Tom and I were talking about this earlier, about tomorrow's speech. Ben Bernanke will be at Jackson Hole, Wyoming, beautiful area, where he will be discussing, well, just basically speaking. And it was the last year, Tom, at this same event, he issued the bond buying program known as QE2. He made that announcement. We're Fed watchers and economists and people like you and me are closely watching what's going to happen tomorrow.
Well, absolutely. I mean, it's got a, as I said, I think part of the markets today at the end, when we saw gold and silver up so sharply, people either know something or are betting their money that there is going to be some kind of talk about either a QE3 or at least some kind of hint that they will not let the economy go into a recession. And we've talked about on the radio show several times is you can't win an election if you've got an economy, and I think Obama will do anything possible not to go into a recession. So that'll pretty much start tomorrow, like you said, and I actually expect this to even be more favorable to metals than a year ago. If we look out between now and the election next year, we're seeing some predictions of some pretty big numbers on both gold and silver.
Yeah, that's going to be interesting to see because, again, last year, even though metals were hot, and we can even build the case, Tom, that even though metals are hot right now, we still haven't entered into that mania stage that we're eventually going to go to. But remember last year, Tom, really all that was in gold and silver was smart money. There really wasn't a huge massive awakening, so to speak, about people were noticing it. They were beginning to notice, but nobody really owned it. You know, it was mainly the institutions and those in the know. But we're really beginning to see now people begin to pile in, and it's still, at this point of the game, I really believe, Tom, and correct me if you think I'm wrong, I think the smart money is still going in. We haven't reached the dumb money phase yet.
No, you're exactly right. We've still got less than 1.5% of investable portfolios have gold, and that is increasing very quickly, even in small percentages, even where people are moving 5 or 10% of their portfolio to gold, that we think is not enough. But certainly if you look at the last 11 years and the track record, most people out there wished they had listened and diversified earlier. But now, like you said, and one point I want to make before we go to the next slide is if you think back to 1977 when gold was 77 an ounce, 3 years later, wow, it hits 800. And this time, we've had a very steady move up, averaging about in a year. for 11 years. We've seen gold
Hey,
go
Tom.
from 256
Hey, Tom,
to 1750.
say that again, because you cut out for all of a sudden. You said go back to the $77 in 1977 and start over.
Yeah, in 1977 we saw gold go from $77 an ounce up to $800 in 3 years. It went up over 11 times. This time, for over 11 years, we've seen gold go up 7 times. So we haven't even got to the parabolic rise yet when all the people come in the market like you talked about, and certainly depending on Obama and Bernanke and Geithner, that could be just around the corner.
Well, the Federal Reserve has been keeping interest rates very, very low, and of course this is how what we basically call the Greenspan doctrine. It was the idea that if there's a problem, cut interest rates. If there's a problem, we go back and take a look at the Russian ruble crisis, the Asian crisis, the long-term capital management crisis of 97, 98. We saw the recession in 2000, the stock market bubble, the tech bubble. We saw the, of course, 9/11. Greenspan responded by cutting interest rates. And we just see this continual campaign, very poor monetary policy. Every single time the fire gets out of control, they run for the gas can and throw more gas on the fire. And here we have the Federal Reserve now committing to keeping short-term interest rate targets near zero throughout 2013. And there has been some talk about how gold is affected by interest rates. Some fear that when interest rates go sky high, that it will harm gold prices. This is basically insurance for those who are looking forward to higher gold prices in the future, because with interest rates this low, it keeps the monies out of the bank and looking to speculate. People are looking for a place to put their money. There's terrible yield out there. It's unreal. And Tom, if you take a look at this next slide, it shows, this is from Casey Research. I thought this was a great slide. I wanted to show it. This is just basically a projection showing by keeping interest rates near zero, it's going to cost a lot of money. If you take a look at this, it took over $2 trillion over 2 years to keep rates at zero. This gray line here, or this black line, is showing the possible projection of what it's going to take in order to keep these rates low. It costs a lot of money to do this. Tom, what's the impact on gold?
Well, the impact's exactly what you mentioned. As long as we have zero rates, gold is very appealing, because people making 0.5% on commercial paper, and half that commercial paper is in foreign debt, which is very risky, and people are getting 0.5% on something they think is not risky, but it is. But really, until interest rates rise, and let's say that interest rates got up to 3 or 4% in normal rates, and they really had a real rate of positive if the inflation was driven down, if we were in a recession, and people are willing to move their money out of speculative things like gold and put it back into bonds. We saw that in 1981. So I think, like the graph shows that Casey Research has provided, we're probably 3 or 4 years away from that, but at some point it is a possibility.
Right. All right. Well, we should also talk about the U.S. dollar, because before we get into gold, I mean, the U.S. dollar is continuing to be in trouble, and the days of the U.S. dollar are numbered. We've talked about this extensively, and we won't belabor this point too much, but I think there's something worth bringing up, and Tom has talked about the U.S. dollar index for some time, the USDX, the barometer of the U.S. dollar. And Tom, why don't you explain what this is? And we're going to go through the next few slides, because people hear this often. They hear the U.S. dollar index, or they hear the U.S. dollar fell against, a basket of currencies or whatever. Well, why don't we talk about this? Let's explain to them what this is. That way they can empower themselves as they look at it, and it helps them understand what's happening in the currency markets.
Well, exactly. That's the reason I put these in there. I get more questions annually about what is the U.S. dollar index and how is it made up. So as the next slide shows there, number 14, is, it's 58.6% weighted with the euro and then the yen. What's interesting, though, the Swiss franc that has beaten the dollar so badly over the past 3 years is only weighted 3.6%. But, of course, their logic is they weight it based on the size of the economy that they're dealing with, which is not a terrible way to do it, but it does skew it a little bit. In other words, I think the dollar is actually weaker than the actual numbers that we get, but 78.3% are European currencies that are in the U.S. dollar index. And if we go back to 1973, when it started at 100, we now know that basically we're down somewhere in the range of 25% total, the inception of that. And as how to interpret the index that we show, when the index is below 100, it's weaker than it was in March of 73, and when it's above it. And when this last move started back in 2000, 2001, when the euro came on the scene, we've gone from 120 on the U.S. index all the way down to 74 plus where it is today, and we've seen, 74.27, so we've seen that it's lost 25.73% of its value since 1970, but since 2001, it's lost 39% of its value, and that's what is really more important than the index from 1973 is in the decline that it's currently in, and breaks 72, where it was in June of 08, is when we really think the crisis would start, and we would have that parabolic rise that we talk about, because almost every timing service in the world has 72 as the major point going back to June of 2008. And if it did break below that, it could go down substantially to 68 or 65 or even 62 that some people think. And what happens, we know from the last 11 years, is every time the dollar goes down 1%, gold goes up 13%. So when you see $5,000 forecast on gold, all they're saying to you is gold's going to go down to 62 to 65 on the index, and there with a gold price of $4,900 approximately. So that's what this is all about. But hopefully this will help everybody understand when we're talking about the dollar, what we're actually talking about.
Yeah, I want to briefly just review this real quickly for the folks, because this dollar index is really important. It basically tracks, as Tom said, a basket of 6 major world currencies, and it helps investors to understand. And it's a really vital thing to take a look at, especially if you own gold. You want to be paying attention to this. And again, this is the breakdown of the U.S. dollar index. Again, he did point out about how the Swiss franc, which is this symbol CHF, is only 3.6%. There's the Canadian dollar, that's 9.1%. British pound, the Japanese yen, the euro making up a huge majority of that pie. And as he pointed out, the baseline is March 1973. And so when it goes over 100, then that means that it's relatively stronger than all the currencies than it was back in March of 1973. That's the baseline, so to speak. Okay, so what's interesting about this, and of course today the current USDX is 74.27. So again, it's 25.5% weaker percentage-wise today than it was back in March of 1973. Notice here, Tom does point out that the dollar index did go above 100, and notice when it did. It was a period there, and I believe, Tom, that was back in September 11th of 2001 and 2002. As a direct result of that, money came pouring in to the to treasuries, for a safe haven. Of course, there was a lot of concern, and that drove the dollar up. drove the value of the dollar up. And so that's really how all of this works, but you can really see how this has just come down so much since that time, and there's a lot of pressure on that dollar. Of course, the dollar is going down, and meanwhile, the monetary base is going up. Here we see the tremendous, in this slide, the St. Louis adjusted monetary base. You see the amount of money in the economy, going up dramatically. This is the monetary base according to the St. Louis Federal Reserve.
Let me comment on that too, Jerry. I don't want to lose my train of thought, but we went from 1983 all the way to 2008, and the monetary base averaged going up 6.8% for a year, which in my book is way too much. But let's say, a fact's a fact. The monetary base went up 6.8% a year. Comes in. And in 2.5 years, the monetary base has gone up 229%. 229% in 31 months. Now, all your listeners know that when you look at the rule of 72, how long it takes something to double, if you've got gold going up 36% a year for 2 years, it doubles in 2 years. If it's going up 24% a year, gold doubles in 3 years. So you look at this monetary base, it's up 229% in 31 months, and we're expecting this to even go higher. And once again, you can see easily with gold sitting at 1770, if gold just goes up 24% a year, which it's been doing years, average, we'll have over $3,500 gold within 3 years. So I just want to jump in and show people how important this monetary base is and what it really means to the investment side of the market.
Yeah, good point. And another slide here showing the effective inflation since 1913, since the days of Jekyll Island and, of course, the Federal Reserve being born. Here's a slide, United States debt as a percentage of GDP. We should probably preface this, Tom, because many people have heard that we just recently hit 100% of GDP. This slide shows over 360%. This includes, I'm assuming, all of the unfunded obligations.
No, it's really the 13 trillion. You've got a GDP annually. I don't have the number in front of me, but I think it's the U.S. debt. It's just an annual thing. This is an annual slide. So I think we're like at 13 trillion of total debt, and I think that the annual GDP is 3-point-something trillion, if I'm not mistaken. So I think that's what that is, the way that reads.
I think, and if I recall this properly, I believe that this U.S. debt as a percentage of GDP may be, regardless of what it is a tremendous amount of
right.
You can see how it's climbed since the 1970s. It's absolutely severe. Now notice this next slide, U.S. federal deficit in billions. This is from 1900 to 2011. Take a look here at the amount of the deficit that's spiked. Of course, we had problems in the 70s, and look in the 60s. Back in the time of the Great Society, back in the time of LBJ, and of course the Vietnam War and all the concerns, and Nixon actually pulled us off of the gold standard because the deficits were getting so high, remember, and Europe was so concerned about our deficits and all of this. Look how puny they look. Look how puny they look compared to the 80s. The 80s, of course, were a big time of deficit spending as we built up our military machine. And then, of course, in the 90s, we really saw a decrease underneath Clinton. Believe it or not, he brought down spending quite a bit. But take a look at what happened back underneath George Bush and then, of course, underneath Obama. Just astounding numbers that we're seeing here. And this is where we kind of come to the edge of the cliff, Tom. This is whenever empires start getting to that place where they're just so intoxicated that they can't turn off the printing presses, you know?
That's right. There's no place to go, in my opinion, except back to gold standard and honest money, and I do think we will be driven to that the next several years.
Just a quick advertisement for those of you who are listening. Our Follow the Money weekly radio show is broadcast on our website and on iTunes every single Saturday. We're also now part of WorldNet Daily. That actually got delayed, by the way. We're actually going to be with WorldNet Daily beginning on Labor Day. We also got picked up by a radio station in Shreveport, Louisiana. And so we're excited about all of that. But anyway, it's broadcast on Saturday morning. Tom is always my guest on there for the Precious Metals Market Update each and every week. Some of the upcoming guests that we have this weekend, Gerald Salente comes on. Gerald is a trip. If you've ever heard him at all, he's quite a character. He and I talk about the TSA at the airport. We talk about a few other topics, and he gives some forecasts. Robert Kiyosaki, good friend, he'll be coming back on the program talking about his latest book. In fact, we might even have a surprise when he comes on as well, something else. So stay tuned for that. Also, Randy Alcorn, he'll be coming on talking about biblical stewardship, kingdom finance. Really good stuff. Randy is a good friend, and he is a very good author, a very good writer. And he'll be here to share about some of the new things that he's doing over at his ministry. Follow the Money Weekly Radio on the web at ftmdaily.com. All right, Tom, I want to move in now because we've talked about the problems extensively. I want to talk about now the beneficiaries of this. We developed something some time ago, our financial philosophy called PACE. It's a wealth strategy for building diversified investments, PACE, precious metals, agricultural commodities, and energy. And the beneficiaries of this economic crisis have been pretty clear. People have turned on to a brand new set of assets that they hadn't normally thought of in the past unless they lived in the 70s, because back in the 70s, all this stuff was the rage just the same way. Things go in cycles, you know, Tom. They just go in cycles. And we're looking here at this first slide, farmland. Farmland is near 34-year highs right now. Illinois farmland up 18%. Iowa farmland is up 21%. But overall, across the country, it's increasing by double digits each year. It's up 20% so far in 2011, that according to the Chicago Federal Reserve Bank. Now, that's one of the asset classes that has been soaring as a result of all of this doom and gloom that we've been telling you about, the dollar falling and the debt and the deficits going higher and the concern. Well, people are putting money into things that won't go away and that cannot be printed. Another area that we believe, now there has been quite a pullback in this recently. Oil prices are flat year to date. They really have gone nowhere as of right now. They did go up pretty dramatically, but then they came back down. However, we believe that many forms of energy, natural gas, nuclear, and of course petroleum, will see dramatic supply constraints due to the growth in emerging nations as we head into the future, and we believe that we're going to continue to see higher prices in these areas. And so we believe that money is going to be flowing to these over the next several years. And, of course, war will drive up these prices as well. Silver prices have soared 80% in 2010. That was quite a ride, Tom, last year. And they're up 34.5% so far in 2011, that according to Tom's calculation as of today and also from Kitco. Another area that has been a beneficiary of this economic crisis, which you may not have thought about, and we're going to talk about it tonight, and that is diamonds. Diamonds. Somebody says, isn't that what we wear on our fingers? Isn't that a good engagement or a wedding gift? But it's not necessarily something that you would invest in. Or isn't that for the billionaire investors? They have diamonds. Well, it is what we're going to call the most extreme form of portable wealth that has ever been developed or that's ever been created. It's a very extreme form of portable wealth, and we'll explain what we mean by that here shortly. But so far for the year, diamonds are up 32%. That's pretty astounding when you think about it. And then finally, gold, and we're going to start with gold, but gold has increased for 124 straight months. It's absolutely staggering. It's up 34.4% in 2011 so far, what Tom has referred to on the program as the 2% miracle, just going up slowly but surely. Well, and I say slowly, it's really just going up dramatically for 124 straight months. It's absolutely astounding. Tom, I'm showing on the slides right now the gold price major upside that we've seen since May. If you look at this chart, it kind of went sideways from May to July, and then if you just look at the beginning of July all the way out to where we are now, it just took off. What caused that parabolic rise back in July? What was it? Do you recall what that was?
Well, I think it was the kickoff of the South Korean central bank and the Thailand central bank buying 25 tons of gold, and we began to see shortage. There immediately developed talk about raising the reserve requirement again at the CME, the Chicago Mercantile Exchange, which we've now seen 6 increases, and it's all for protection because they know that the gold is not there. So now that people are taking delivery of physical gold, and then we saw a couple of weeks ago when Chavez ordered his gold back to Venezuela. So all these events, people are starting to get it. They're starting to understand it. They're starting to figure it out. That a lot of the gold that people think they own in ETFs and future contracts are not real. And what has caused this rise has been a huge buying of physical gold for delivery.
Interesting. Yeah, that's really what's happened here. We've seen a tremendous amount of buying activity, a lot of buying pressure. On the next slide, we're showing the gold, the long view, this from Stock Charts and Daily Wealth. It shows the gold could fall. And look at this trend line here. Notice this blue line that kind of captures the support level for the price of gold. This goes back to 2004. And you'll see, and this is what's interesting, Tom, that based upon this trend line, gold could fall all the way down to $1,400, and if it did, I would be a major buyer, of course, there. I'm happy to buy where it's at now, of course, on the pullbacks, but at $1,400, you got to be kidding me. But if it did, Tom, if it went back to $1,400, it would still be in an uptrend. Isn't that amazing? It's just astounding.
Well, it is, and you know, it had one pullback this year already, 6.6%, and then we've had this pullback here in the same range since last week, and yet, like you said, it's still up, got 34% for the year. So it's, you know, there's a lot of demand, there's a lot of interest, and we think our technicals also show that if it did go back to the major support line that we have at 14, I think it's 1432. I don't have the charts here, but 1680 also is a major support level that we don't think it would go back below. But either way, we're still up increases after Labor Day.
Say that last part again because you cut out.
So we're still looking for sharp increases from Labor Day through the rest of the year.
Oh, okay, yeah, absolutely. All right. We're going to go through several different reasons why own gold. Why own gold? For those of you who already own it, these will just be affirmations to what you've already done. To those of you who have not, here are some reasons to consider. Number one, gold is returning to its true historic role as money. We're certainly seeing that right now as, you know, for history, all throughout history, gold and silver have been considered money. And just until recently, in 1971, when the Nixon shock occurred and Nixon took us off of the gold window, or he closed the gold window and took us off of the gold standard, we moved into this new era of global fiat currencies. And it's, as we've called it on the radio show, it's been a terrible experiment. It's, you know, I guess we had to try it, I guess, Tom, but we tried it and we saw the results of it. It's not working out. And so gold is beginning to reassert itself on the global economic level as its role, its true role of money. Reason number two is the basic collapse of the U.S. dollar is coming. It's basically a foregone conclusion. We've talked about this extensively. Tom, you put together an interesting chart here. Gold outperforms the dollar 13 times, as you pointed out. Walk us through this chart real quickly.
Well, on July 5th, 2001, we had gold at 265.35. The U.S. index, dollar index, was at 120.9. And through July 27th of 11, we had gold at 1612 and the U.S. dollar at 73, which showed that gold had gone up 507% and the U.S. dollar had gone down 39%. So we knew that every time the dollar went down 1%, gold would go up 13%. If you go to the next slide, if you say with gold sitting there at 74 or slightly over, if the U.S. dollar index comes back to 72, where it was in June of 2008, we're looking at $2,031 gold. If it comes down to 70, 26.59, and so on, until you get up, if it drops to 65, which is the most talked about number by almost every economist on the planet Earth, you would have gold at 4,126. And we think the probability of that happening is extremely high. And certainly if Obama were to get reelected, I think it would be a certainty. And even if Obama is not elected next year, there's still a strong probability. But in the case that the dollar broke all the way to 62, then we'd be looking at $5,000 gold, and that is something we can't ignore. And I think it's just very important that we look, it's what's causing this, and we talked about earlier these easy money, the implementation of zero rates have to lead to hyperinflation at some point, unless they let the economy go into a deep recession, depression, and that just has not been what this administration has done, and we don't think they will. So eventually we're going to have the dollar dropping, inflation picking up, interest rates will start up, but the question is, will they keep up with that? And the last slide that you have listed is number 36, is when the debt limit was raised by Congress back the first week of August. We look at it and you can see every time our Congress promised they would never raise the U.S. debt limit again, there's been something like 11 increases in only 16 years of the debt ceiling, and every time they raise the debt ceiling, look what happens to gold. So gold's doing right now exactly what it's supposed to do when you devalue the dollar through raising the debt limit, printing more money, more fiat currency, nothing to back it, money by decree. And I think these charts don't lie. They show you a nice 16-year history of what's going on when the debt limit goes up. So that pretty much is a summation, reason 1 through 3.
Yeah, and reason 3, by the way, was the destruction of government balance sheets. And we do have a balance sheet problem in this nation. That's really what this is all about. We just simply have just gone off the rails when it comes to monetary policy, seeking to keep interest rates at near zero. And there really is a way to flush all this out, Tom. This is what we talk about in Bankruptcy of Our Nation. We talk about the sacrifice that many generations before us have went through. There's a period of time whenever, if you're fighting a war, you pay for it. You pay for it. You issue war bonds or whatever. We've gotten into a place now where we don't want to have to pay now. We want to pay later. It's that whole buy now, pay later mantra that's been forced on us by the marketers and by the advertising agencies. Well, the government has been the number one promoter of that philosophy by choosing to basically put off the bill, kick the can down the road, so to speak. And that's where we have ended up. That's where we find ourselves. And, there really is a simple solution to all of this, but no one would like it. I wouldn't like it, and you wouldn't like it. But in essence, what we have to do is we have to stop spending. We have to stop spending. We have to cut programs. We have to do a whole lot of cutting, and interest rates have to be raised. And the reason that interest rates being raised solves the problem is because, and I think we need to point this out real quickly because we've talked about a lot of grand themes here. Interest rates, what they do is they serve to regulate the economy. How is that the case? Well, think about this for a minute. If your bank, just put yourself in this situation. Let's say you're driving down the road and your bank is offering 20% on the CD. Are you even listening to this webinar? I mean, are you're hopping in your car, right? You're flipping off the TV and you're making a beeline to A&B Bank, and you're going to put all your money, as much as they'll let you, into that. Well, maybe up to the FDIC limit, but you'll stuff as much money as you reasonably can into that 20% CD. Are you kidding? That's a great amount of money. Now, here's the point. That's what happens around the country when interest rates are high. What does that cause? That causes all the money that's out there looking for a place to land to be sucked back into the banks. Okay? So that's how the banking system works. The interest rates are kind of like they're kind of like pulling on a rope. You can pull money into the banking system by raising the rates. And then you can also push money out of the banking system by lowering rates. Since we have near zero rates, what is the Federal Reserve trying to do? It is trying to get people to use the money, to pull it out of the bank because there's no use in keeping it there because of zero rate, and go use it, go invest it, go consume, go buy a car, go do something, go travel, just go spend the money. But the thing is that that's not what's needed right now. They're going to tell you that we need to consume. That's what we need to do. We need to consume. But no, the problem is that we've got too much consumption going on in the first place. We have got to start producing in this nation. We have got to stop consuming. We need to save, and we need to become much more, I would say, disciplined when it comes to these areas. So there are ways to solve this, but it's a very, very painful process. Okay, reason number 4, and by the way, I hope that helps some of you understand about the interest rates. Reason number 4, other significant world currencies offer no refuge. Tom, we do talk about the Canadian dollar and the Aussie dollar and the Swiss franc, and we do like those because they certainly are, they have smaller holes in the boat, so to speak. They're not sinking as fast as the dollar. But this chart here shows the depreciation of major currencies against gold. Everything's going down against gold. It really doesn't matter. All currencies do, don't they?
Well, they are. And the other thing, you've got every major currency. Nobody wants a strong currency. They want to produce jobs. They want to manufacture. They want to sell products to other countries. And we've even seen Switzerland, their currency got so strong, they've intervened and pushed their own currency down. Nobody wants a strong currency. It's not good for their economy and slows it down. So now you've got countries wanting to lower their currency. So everybody's in a race to see who can lower their currency and, like you said, cause and create spending.
Right. That's exactly what they want. They want more consumption. Reason number 5, true impact of the malign side of derivatives has yet to express itself. Boy, that's a whole can of worms, Tom. We won't go there too much, but you're right.
No, we don't need to go there. That's just trillions of dollars that hasn't been created yet. That's going to be created out of somewhere, or the system will fail.
Reason number 6, investment demand for gold is rapidly accelerating, but we're only in the early stages of this phenomenon.
Truest statement of the night. It's never seen anything like it in 34 years. It's big money's coming in, little money's coming in, countries, central banks, everybody wants to get a percentage into gold, and you've got countries like the U.S. that have over 65% of their reserves in gold, but they don't want the consumers and citizens to buy it. They want us to consume, but that's where the U.S. has their reserves. And then we have countries like China that over the next decade will grow dramatically, and what percentage they have in gold as reserves that today have low reserves. So we're really in the early stages with all these Russia, Brazil, these countries you mentioned earlier, the BRIC countries, as they and their citizens save, and their preferred savings is gold, in particular gold, is going to just continue to put pressure on the fiscal side of it. So we think we're in the early stages of what is going to be a fast-moving up market the next several years.
Reason number 7, growing recognition that many paper gold products do not have the gold backing that they purport to have. And we've certainly seen that playing out. Reason number 8, mine supplies not anticipated to rise for several years, if at all. That's certainly true, Tom. We're seeing that. Number 9, central banks are nearing an inflection point where they're no longer willing to be in a position to supply the gold necessary to keep the market in equilibrium. Interesting, we should also bring up the Venezuela event that just happened the other day. It was big news this week, last week. But Hugo Chavez wanting to nationalize his gold industry, calling in gold from the Bank of England and all of this, and really kind of causing a little stir, does create some concerns about whether the gold is there or not in some of the different areas where he's pulling gold out of, because there's so much shorting going on. But interesting to see that we're beginning to see a shift. Lots of central banks buying, and of course countries like Venezuela who are simply nationalizing, trying to bring the gold back.
Right.
Reason number 10, large short positions, as I mentioned, in the precious metals markets. And the reason that's important, Tom, let's explain why that's important.
Well, they take large short positions. They bet on it going down, and J.P. Morgan, of course, is the most famous name, Goldman Sachs. But they'll go in and take short positions, but they're only in it for such a short period of time. They're trying to take, like some starts downhill, they want to jump on and ride it real quickly and then come out, take quick profits. But it really has nothing to do with the long term, and in a lot of cases, because it pushes the price down, it only brings in more physical buyers, and that's what's been going on the last 2 days. They pushed it down. They made a few $1 billion, but in reality, all it did was create an opportunity for people to have a sale and get in on a 5 or 6% sale in gold, and is now catching up with these people that are shorting it because it's not doing anything good. They're not scaring people out of the market like they were 2 years ago when they would have these large shorts and we would get 4, 5, 6% drops like we just had. So that's pretty much come to an end.
Reason number 11 is increasing skepticism about the U.S. gold reserves, and we've certainly seen that, especially coming from Representative Ron Paul and others. Reason number 12, increasing recognition that the fact that the gold price has been seriously suppressed. We've already alluded to that tonight. Reason number 13, that the relatively small size of the gold market. That's another area that many people don't realize. It's just not, they can't just print this stuff up and give it to every person who wants it. At some point, it becomes a bidding war because there's scarcity. Reason number 14, gold is an established, powerful, or is in an established, powerful bull market. As we've stated, it's gone up 124 straight months. It's just simply astounding. Reason number 15, there's an increasing likelihood of accelerating purchases of gold by Eastern central banks. And we certainly have seen that, Tom. They certainly like the gold over in those areas. I mean, there's just no doubt about it. And the next slide shows that we are entering into, speaking of the East, we are entering into the 2011 gold season. We talked about this on the program, how the fourth quarter really heats up. It's that time of year that really just, there's a lot of gift giving, there's a lot of gold demand. Why don't you explain these 4 events here and how they impact the price of gold?
Well, what you have the Muslim holiday, Ramadan, and you're going to have them putting their money into gold, not only for investment, but for, well, they don't think about it during the season or during the week. They have it. And then, of course, the bigger one is the 1,000 tons expected to be bought this time by the harvest season in India and the wedding season they're entering into. And it's estimated that 2011 will be the biggest in history as far as the amount of tons of gold purchased. And the Christmas season in the U.S. has a lot to do with jewelry, not just investment, but people buying rings and necklaces and bracelets, and it does take gold out of the market, especially when the economies are good. And the Chinese New Year has almost become as important as what goes on in India, because they take their bonuses, they take their savings, and unlike America, they are encouraged to buy gold and silver to hoard as their investment money and to hold, not to put the money in bank. They want to see them make more money where they have more to spend. So it's a totally opposite of what we do in the U.S. Our government tries to encourage us not to buy gold, saying it doesn't pay dividends, it doesn't help the economy, while the Chinese do just the opposite. And there's one other thing in there that's very important that's underestimated, and that's the fiscal year ending in the U.S. because of the debate over a new budget, money created to balance at the end of the year. And you always see the dollar go down in September. It's been a standard for many years, even including the 1990s. You would always have the dollar go down during the month of September. So all of that feeds in to gold prices going up. And I saw a graph recently where 64 or 5% of what gold has gone up in the last 11 years has been in the last 4 months of the year. 1/3 for the first 8 months and 2/3 for the last 4 months. And certainly if that were to happen this year with gold already up as much as it is, it would be phenomenal. I'm not sure it will do that this year, but I do think it'll have a tremendous fall for the next 4 months. And lastly, to say about it, you know, you need to get in before Labor Day, because after Labor Day, starting on Tuesday, I think it's 6th of September, we do expect gold to start moving. Even if it doesn't move this week or next week, we expect it to start moving the day after Labor Day.
Very interesting. Yeah, we do expect that big fourth quarter. Now, gold, interesting slide here. This is from Shadow Stats, John Williams, who runs that organization, where they keep track of many of the statistics that just not reported by our federal government. This shows that gold must triple to reach the 1980 high when you adjust it for inflation. Remember, it reached $850 back in 1980. And since then, take a look at the rise that we have had. Of course, this doesn't include 2011, but you can imagine that it didn't quite go up that dramatically. So you can see that we need to triple from here just to get back to an inflation-adjusted gold price that we had back in 1980. So even though back then it was $850, that shows you how much we've lost in purchasing power, that we have to triple that just to match it. So you can see there that we have quite a ways to go. The final reason why to own gold is that gold has endured. Why don't you speak to that, Tom? Gold it's been around for eons. When we even think about, I think it's somewhat strange to bring in the topic of the Bible on this because it seems so secular. Gold itself just seems secular. You know, even the Bible talks about, there's a scripture where it says, God says, the gold and the silver are mine. He also, as you read through the Bible, you'll notice that the word money is often translated for the same word as silver in the biblical languages. So it's almost as if money itself is considered these types of assets. Gold and silver, they are money.
Well, they were money. I mean, it really starts in Genesis 2, where God put gold in the Garden of Eden, and that's what they used as trade. And of course, later on, paper money became a receipt for gold because you didn't want to carry it around. But and then we certainly see in the book of Revelation, so God talks about gold all the way from Genesis through Revelation, including what you're talking about. But gold's endured throughout recorded history, and gold will endure again. This 39, well, we're coming up on the 40th anniversary of Nixon and the gold window, and certainly it's been a horrible experience And there's no doubt, as I've talked to my European connections, 30-something years, and they're saying there's no way we're not going to be back on a gold standard sometime in the next 2 to 4 years, in their opinion. But we will go back because it really is the only asset on the planet Earth that every country in the world can agree on, and it is reproducible, it is homogeneous, it's got every attribute. The more heat it gets, the purer it gets, and it will be money again, in my opinion, in less than 5 years. So that's the reason gold has endured for thousands of years, and it will endure until the Lord comes again.
All right, so we've talked about gold. We also want to get to silver and also diamonds, and we still have about 30 minutes left. We're going to talk about silver. We did see one question here I want to get to real quickly from Michael. Michael asked the question, and Tom, I hear this a lot. You probably do too, and it's a really good question because I know many people do ask it. I think it's really good to address it right now. Michael says, when it's time to sell my gold, wouldn't I just be buying worthless dollars with it? He makes a kind of a logical point there that it's good to go put your money in gold, but then eventually you have to jump back out into dollars anyway. How do you answer that, Tom?
Well, I think it's something you consider up front, and either several things could happen. You could see that CD rate or bond rate like we saw in 1981 when you saw bonds up at 14%, and we were buying bonds at 14%, and then the rate started dropping. So it was a huge windfall profit by timing it and taking your money out of gold and putting it in bonds. And certainly when you are ready to sell, you move it quickly from gold to the bank account to your right to check out for whatever. Maybe it's farmland you're buying. Maybe it's bonds. Maybe you just need money for a new car. So you're really, you will have places to go put it because the events that will make you want to get out of gold or think that gold is topping will present opportunities in other areas, as it always has.
Yeah, that's a good point. And, David also, he's listening to us tonight, and he commented, he says you would basically be able to afford real assets with cheap dollars at that point as well. So all good points. If anyone else has a question, feel free to type it in. We'll come back and check this question box here momentarily. Let's move briefly into silver, Tom. Silver really had a big run, as we talked about last year, 2010, 80%. Wow, it caught everybody's attention. And then it took a big nosedive, and everybody kind of got worried because it lost so much so quickly. And this was something that both you and I discussed, that silver is volatile. It's a highly volatile metal compared to gold. And so I'm going to show some charts here. I want to go through these real quickly, Tom, and then I just want you to kind of talk about what you're seeing in the silver market and what you're seeing as we head in. We've already talked about gold, doing well toward the end of the year. I want to know what you think about silver. Here's the 10-year chart. We see that it's done very well over the course of the last 10 years. I remember buying silver back in the day for around, $4 an ounce, $5 an ounce. It was really good. And, of course, it stayed at that price forever. It never moved. We never had the kind of action that we see today. Of course, now it just moves, sometimes it can move $5 in a day. But, back then it was just $5 an ounce. 1 year silver, here we see this. We see a real nice uptrend. And then, of course, that big nosedive that occurred around April, May. That was a tough time for many people. People got scared. They didn't know what to do. And understandably so. Here's that 6-month chart that really shows how pronounced that drop was, because it was parabolic right up to that moment. It moved from $34 all the way up to $48 dramatically quick. And it was even up to almost $50, and then it came crashing down. And then here's a 30-day chart of silver. You can see that it's been very volatile. It's been as low as $38, and it's been as high as almost $44 in a period of 30 days. So, Tom, this is a very volatile metal, and people getting involved in this should know that up front, shouldn't they?
yeah, it is. It's industrial metal first, investment metal second. But as the masses move in, like they did in 1977 to 1980, a lot of people can't afford gold, so they know they need a hedge, and they move to silver. And then you have industrial people that get concerned about shortages in products they're making, the huge demand going on for electronics the next decade, and these developing BRIC countries that you alluded to. You just think of how many different cell phones, computers, iPads they'll each own, and you start looking at the content, and if not one investor bought any silver, of course it's investors that make it volatile, but if not one investor bought silver, it would still go up, it's estimated 8% a year for the next decade, which would return on its own. But certainly when industrial people need it and they want to buy it cheap, you're going to have people shorting it. You're going to have rumors of depressions, rumors of recessions, and that does not affect gold like it does silver. But silver, if we do go into an expansion created by money expansion and inflation picks up, silver still has more leverage than gold, but certainly it must be considered more volatile. It doesn't have 120-something months of going up in a row. It's not a 2% a month miracle, but yet the other thing that it's used for, if we do have a banking crisis, you know, gold's way too expensive for barter. You really need to have some silver, 1-ounce coins or junk silver to have for barter. So that's another reason to own it. So you just need to know that it is a completely different animal than gold, but we're still on it, even though I expect the volatility to continue.
Okay, that last part again, because you cut out again, Tom. You said you do expect...
I said even though I'm very bullish on it, I still expect the volatility to continue.
Okay, got it. Absolutely. We have some more questions. And by the way, before we get to those, what's driving silver? Because we're going to move over to diamonds now to make sure we have plenty of time before we wrap this up. We want to be done by the end of 90 minutes, as we had said at the very beginning. What's driving silver? Well, here they are. The gold-silver ratio, the increasing investment demand. Of course, that's something that that Tom had mentioned. The increasing industrial demand, declining mining production, and, of course, overall economic uncertainty as people are looking for a place to go, and many people can't afford that gold. And so silver makes a great alternative for those who are looking. Now, the questions that I saw, some of these, Tom, are pretty good because we're actually probably going to answer some of these when we get to diamonds. First of all, I don't know if you heard last week's program, Tom. I had Peru Saxena on. Peru is a fantastic gentleman. He's a good friend, and he lives in Hong Kong. He's a wealth advisor. He made a really good comment that many of our listeners really enjoyed hearing, was that he believes that, and he's been a big bull on gold and silver for a long time, his view is that he's going to be pulling the trigger to sell. He's going to hold his gold all the way through, but he believes that whenever it comes to the Dow and gold price being 1-to-1, 1 ounce of gold to the price of the Dow, he says that's when he's pulling the trigger. What do you think about that?
Well, we've been talking about it. I had a slide in the webinar we did either last time or the time before, and we showed that ratio going from 44-to-1 back in where it took 44 ounces of gold to buy one of the Dow Industrial, each of the 30 companies, and here it is now down to 6 point something, and I do think it's headed toward 1-to-1, and I think it'll cross somewhere between 5,000 and 7,000 an ounce. I've been a proponent of that for about 3 years. I would wholeheartedly agree with your guest from Hong Kong on that.
Okay, perfect. Yeah, 1-to-1 seems to be the good ratio for those. And, of course, that doesn't necessarily mean the gold's going up to 11,000. It means that, you know, the Dow could come down to 7,000 or something, as Tom had said. So, but when the Dow and the gold price are 1-to-1, that seems like a good time to cash in the chips, so to speak. All right. So that was Calvin's question. Very good question, Calvin. I really did appreciate Peru's comments on that, and I do really enjoy his all of his commentary that he brings onto the program every time. Okay, Michael asked the question, and we're going to talk about this in a minute, Tom, so we'll save the answer for this. But he says, would it be safer to store gold and silver in other countries, and how would one do that? You and I discussed that tonight. We're going to bring that up here in just a minute, and maybe an alternative that you haven't considered. Margaret says, on the topic of selling gold or silver, if one owns physical gold or silver, is the best way to sell to lock in a price with a company that may not be located locally and then ship and insure it? So
yes,
is that
you're going to get the best price by sending it to the wholesaler that's paying the most, and we provide that service for our clients on the back end when they're ready to sell. We'll tell you where to ship it, which warehouse, and we'll sell it for you, and the price will be locked in once you mail it and give us the registered number.
Okay, perfect. And so you do that for the customers, and you don't actually charge a back-end commission as some of the places out there do?
No, we don't charge any back-end fee for that.
Okay. Margaret, I hope that answered your question. If not, let us know. Dana asked the question, is there a safe online option for buying diamonds? If not, where's the best place to buy? We're going to talk about that tonight, Dana, so we'll answer that question. Nick asked the question, Jerry, what are your thoughts on the threats of high taxes or confiscation of gold if it gets too high? The high price of gold makes those that believe in paper money look bad, and they are very powerful. I don't believe that those in power will outright confiscate gold like FDR did, but what about a windfall profit tax or an extremely high capital gain tax when you try and sell the gold? Okay, if you want to address that, that's fine, but I really think what we're going to be getting into here in a moment.
Yeah, we're going to get into it, but 28% they've raised it to. I don't think they're going to raise capital gain, and Jim Rickards talked on King World News that he really trying to drive the price up because we owe the Chinese over $1 trillion in bonds, and if gold were to go to 5 or 6 or 7,000, there'd only be about 1.5% of investors profit from it, and it would make the government easier to pay off the Chinese and be a lot less pain. So I'm really not sure that our government doesn't want gold to go up. I'm really not. If you think about it, it makes a lot of sense since they own over 256 million ounces of it, that they don't want it to go up.
There's another question here from Jill. Jill says, are you advocating holding precious metals and avoiding or minimizing stock positions? That's a good question, Jill. You know, to be honest with you, just my own personal philosophy on this. Tom has his own, I have my own. I know Tom knows the precious metals markets very, very well, and so he would probably be considered over-leveraged in them because of his knowledge. It doesn't mean that everybody should be that way, but, you know, for somebody like him who understands it intimately, it's his business, well, then that makes sense for him. Now, for somebody like me, what I do, I am really just an entrepreneur. I'm an investor and an entrepreneur, and so What I like to do is spread out my money in many different ways. I like to hold gold and silver, and I like to be a good amount of my portfolio absolutely, positively physical. But I also like stocks, and I don't necessarily like, all of the high-flying tech companies out there. We do have our FTM investment portfolio. In that, I do like high dividend-paying multinational corporations. I do like those. The big dividend companies are one of my favorites. The energy companies I do like, and many of them right now are on a very attractive price, especially when you can see a dividend on them. So, no, I don't think that we should throw away stocks, but I think we need to be very, very selective on that. And let me tell you something else, too. It's also very important to be also investing in yourself or even in your own business. This weekend, for example, last weekend, I ran into an opportunity. I found an opportunity that just presented itself to me, and it was a venture capital type of situation. And it was a fantastic opportunity. And so I had money, and I said, I'm going to put money into this. And I did. And it's not a stock, and it's not a precious metal, and it's not a bond or a CD. It's nothing like that. Instead, I'm investing into someone else's business, okay? So there's so many different ways for us to spread our wealth. Remember Abraham from the Bible. He was rich in gold. He was rich in silver. But he was also rich in cattle, and he was also rich in slaves. When you're rich in slaves, that means that you're a business owner. You have, that's the modern version of employees, friends. You got to admit it. That's how it is. The master-slave arrangement is no different today. And so he had a company. He was running a business. He had people working for him, working the land, working the livestock, all of this. And so anyway, there's many different ways. And so we certainly don't view the world through the lens of just gold and stocks, and there's where we need to be. I know we talk about that a lot, but there's many, many other areas to be invested in. But gold and silver, yes, they do represent a remarkable opportunity right now. And on the dips, my friends, is a good time to be doing this. Now, Jill says, what is a good percentage to hold in precious metals? Tom, I want you to comment on this, but I'm going to go ahead and jump out and say what I think, that in your savings, in your 6-month savings, I think you should have 1/3 in there, period, for your 6 months liquidity. But then when it comes to your investments, it all depends on your risk profile. For me personally, I feel very comfortable at 1/3 of all of my investments in precious metals. I don't bat an eye at that. 50%, that's too much for me. Now somebody might say, well, Jerry, you've made a compelling case. Tom and you have just both talked about the compelling reasons to own gold and silver. Well, friends, that's true. But at the same time, we don't want to over leverage. We have got to spread ourselves out. And so gold and silver make a very good addition, but I would say only up to 33%. Tom, what do you think?
I'll just stick with you in the essence of time to get these other things. I think the range is 25 to 40%, and certainly if you look at the last 11 years, how much better off people would be if they had had a third. But I like that third number. That is the most common number that I hear.
Let's move into one more question. Can I buy precious metals in my IRA? We've discussed this before. Tom, can they?
Yes, they can, and there are different custodians. The two that I use the most is SterlingTrustCompany.com and GoldStar. You can go on their websites and download their thing. You can have precious metals, self-directed IRAs. Then you've got to pay an annual fee for the custodian and an annual fee for the storage. I think for education, if you just went to either SterlingTrustCompany.com or GoldStar and looked over everything, you can get all the answers. They both have question and answer sections that will help answer all your questions. And then when you get to the section about a broker, you could give me a call and we could talk about what percentages in gold and silver and palladium and go over all.
Okay, Tom, Ed has a question. Of the 1/3 investment of that 33% that we were discussing in the metals, he says, is it wise to have half in an IRA and half in your physical possession?
I really don't think it makes any difference. I think you've got, I look at my investments at everything I have available, whether it's personal or retirement or whatever. You look at it and know that you control it, and you add all that up and then take a percentage of it. So I don't really think it's important where it is, but you definitely want some physical for if something really breaks down.
You definitely want to have it with you. I'm going to go over these real quick 5 common mistakes that new investors make, Tom, and then we're going to move right into diamonds. Number one, one of the most common mistakes when new investors with gold and silver is they are talked into buying the more expensive numismatic coins. Not to say that these can't have their value, but oftentimes people buy those instead of simply buying the less expensive bullion coins and bars, which really serve the same purpose to protect you from inflation. And many times you'll pay a much, much higher commission. Tom, your commissions on your gold and silver are dramatically low. That's one of the reasons why I was attracted to you in the very beginning, because I did see all of the high commission salesmen out there in gold. I don't want to mention some of the names, but many of these big companies, they charge a lot of money on the commission side.
Right.
And number 2, buying gold ETFs and then thinking that you own physical gold. That's certainly a mistake. Doesn't mean that you shouldn't buy a gold ETF. They do certainly they're great for trading gold and silver, but just don't think that you own anything. You don't have any ownership, unfortunately. All you have is a piece of paper. Number 3, having unrealistic short-term expectations. Be real careful, friends. When you jump in and buy gold and silver, don't expect it to go up 20% overnight. It may, but don't buy it for that reason. You want to buy this because you believe that you want to buy gold because you don't trust the government. If you trust the government, you shouldn't be buying gold. And if you don't trust the government, you probably need to ask yourself why you don't have any gold, because that's one of the biggest reasons for buying it. Number 4, buying from multiple dealers. That can really raise your overall costs. And number 5, knowing how much to invest. Some people put way too much in. Some people don't put enough into it. And so those are the 5 common mistakes that new investors make. All right, well, we're going to move into the introduction to diamonds investing, diversification in your financial plan. Tom, I'm very excited about this new offering because it's a very, very interesting thing, something that people may not know about diamonds. Another golden opportunity here, up 13.8% per year since 1938. Is that a typo?
No, that's definitely not a typo. I started in 1975, 2 years before I started in gold and silver, and True O'Malley Incorporated still exists today, the company that I started with Dr. Joel Aram back in the late 1970s. And we've seen these kind of returns continually going up. And, of course, De Beers controlled the supply, and then finally De Beers settled with the U.S. government on antitrust violations, and actually diamonds have actually gone up more since that has happened than they did prior to that, because they pretty much could control how much they put on the market, since they had a monopoly on the supply worldwide. But after splitting up, we now see divided around the world a lot of different major suppliers. De Beers certainly still has a large percentage of diamonds, but nowhere near what they used to have. But absolutely 13.8 is exactly the published figures of what diamonds have gone up since 1938, and that is a per year appreciation.
That's really unreal. And I think when people think about diamonds, especially those who may be new to this, and I have to admit, I've done a lot of different investing over the years, and I've never really considered investing in diamonds. And when I first thought about investing in diamonds, I thought, gosh, are you talking about walking into a retail store and buying, a diamond ring and then holding it for a period of time? You're not talking about that going up 13. You're not talking about jewelry. You're talking about actual loose diamonds, correct?
Yeah, I'm talking about loose diamonds of certain quality. When we get into the Diamonds 101, the 4 C's, which I guess would be the next slide, carat weight is important, because every kind of diamond, whether it's a white diamond or whether it's a yellow diamond or whether it's blue, green, any of the real rare colors, there's a rarity of every different colored diamond where we consider it to be an investment. We don't have time tonight to go in for each one, but I'm happy to discuss that with anybody individually. Then you look at the color, and once again, if it's a white diamond, you have D, E, F, G, H, I that can all be considered an investment under the GIA grading scale, the Gemological Institute of America. And then you get the clarity. That's how free of inclusions is the stone. Does it have any dark carbon spots in it? Are the inclusions white inclusions that can't be seen with the naked eye? And then the cut. How well cut is the stone? People don't realize it, but every parameter of a diamond can have a deduction. The culet size, the tip of the bottom of the diamond, how flat percentage is the depth percentage, the table diameter, which is a flat part on top, how wide is that to the total width. And every one of these factors factor in to the price and the rarity. So what's rare for one diamond may not be rare for another. So it's knowing every color and knowing the 4 C's, the carat, the color, the clarity, and the cut of each and every different color diamond.
Okay, let me go back and just briefly cover these, because these are really how a dealer assesses a diamond, and so how an investor should as well. The carat, which is basically the weight. People have heard of, a 1 carat diamond or a 2 carat diamond or a 5 carat diamond. Of course, the higher the more. Basically, is that the weight? That's like how heavy it is. Is that on a scale? Is carat kind of?
Yes.
Okay, and then also the color, as you mentioned. Sometimes to the naked eye and to people who are untrained, you can't tell that there's any color in it. But apparently there can be some color in a diamond, and apparently that's what they look for. Also, the clarity, as you mentioned, I have seen that before. I have seen diamonds that do have some imperfections in them that you can see. And, of course, I guess the least amount of imperfections, the more expensive that they are or the more valuable they are, Tom?
Right. That's correct.
And then finally the cut. And apparently you can have a nice cut diamond or you can have a real rough cut. I've heard of that before, the rough cut and the clean cut and all of that. And so these are the 4 C's that Tom is talking about on how diamonds are valued. Now, here's some facts about diamonds. Number 1, diamonds, as we said, their prices have increased 13.8% per year since 1938. Globally, diamond use breaks down like this: 80% industrial and 20% goes into jewelry. Industrially, they're used in many different areas for all different types of things. Thirdly, notice this: the colored diamonds. There's blue diamonds, pink diamonds, yellow diamonds, as Tom has already alluded to. Blue diamonds have doubled in price every 5 years since 1970. Pink diamonds have doubled in price about every 6 or 7 years since 1970. Yellow diamonds have doubled in price about every 8 to 10 years since 1970. Now, that is really something. Tom, you have been selling diamonds for how long?
Since 1975, 36 years.
The reason that we're talking about this now, because we really haven't talked about this up until this point, but there has been a big interest in China and in India and in some parts of the world where we're beginning to see investors moving into diamonds. And one of the biggest reasons why people are going towards diamonds is on this next slide, which people have alluded to the questions tonight, and something that you and I are both concerned about as well, is, first of all, it offers that asset protection for those who are concerned about government confiscation. Secondly, those who are wanting to perhaps hold their assets offshore. This allows them, diamonds, as you've so eloquently said, you can hold a multi-million-dollar portfolio in an envelope.
Yeah, no question, Jerry. And with all the laws through the Luxembourg court cases, Cayman Islands, Costa Rica, and people move gold offshore and they don't do anything improper, they may not let the government know they have it, and you've got to claim offshore accounts. And unfortunately, if you put gold offshore, it's considered an offshore account, and you've got to disclose that. I've seen nightmares as people try to do what's right for them and their family by diversifying and moving, having gold in other countries. And there are ways to do it. It's certainly possible, but it's something that I went over to Austria 2 years ago to look at one of the major people that do this, and I just couldn't get comfortable based on all the cost and just the risk I felt that if I moved gold off there and had to claim all this, that it was more risky than just keeping it. But what's great about diamonds, you can literally have them in your pocket. They don't show up on the text devices. Your wife can wear them on her hand out of the country, and you can have over $2 million of diamonds in the fist of your hand. There is no other asset that's portable, and they are liquid anywhere in the world. Now, you do need to be sure you have the right kind of certification. Any diamond that I sell will have a GIA certification for any colored diamond, where I'm directing most of my clients are into the yellows and pinks and blues and the greens. And yes, they are expensive, to most people. But when someone that's wealthy is trying to put 5% of their portfolio into something with this kind of track record, that's the kind of diamonds they're looking for, to pack a large amount of concentrated wealth into a small area. So to me, it makes a lot more sense because you've got something like gold that's fully accepted anywhere in the world, demand growing dramatically, and the double prices where you see yellow diamonds doubling every 9 years, which means that's about 8 a year. I think are now going to start doubling every 4 years, and the returns will be more like 18% a year. Now, that's the reason we think it's important that people look at this, especially people with portfolios, that get over $100,000, because really an investment diamond, you plan on spending at least $5,000. And the more you spend, the more rare the diamond's going to be, and the better chance you have for a higher appreciation. So I think it's important that people look at it, and I know my clients over the last diamond clients, gold clients have been with me for 20, 25, 30 years, have seen, an overall return higher over the last 25 years than in gold, actually, in the diamonds, the ones that have the select investment grade diamonds. So that's what we think is a very important way to have something portable, something that's accepted everywhere in the world, something that's confidential, something you can easily transport. So with that, I'll kind of go back to you, Jerry.
Yeah, I think that's good because if you were trying to skip out of the country, if you're decided I've got to get out of here, Obama gets reelected and everything starts going crazy, and somebody says, "Look, I've got to get out of this country," and you hop a plane, for the next next plane to Panama or next plane to South America. And you hop on the plane and you're bringing with you all of your physical gold. Well, they're not going to like that so much. They're probably going to make you check it, and so you can't really walk out of the country by doing that. But interesting about with diamonds, and again, this is where many of the savvy people are going. Richard Russell even the other day, Tom, he's been talking about this quite a bit.
Richard's huge into diamonds. I know the fellow he buys from is a good friend of mine for many years. The other point that we didn't put on the slide that I want to mention, just going back to 77 to 1980 period, even when you saw gold go from 77 to 850 in 3 years, the diamonds were not quite that high. But when gold fell from 850 back to 400, the diamonds just quit going up, but they didn't fall. And I think you'll see as people look at, especially if Obama's reelected, especially if we have more moderate inflation than we're expecting, and people have all the gold and silver they want, and they can't afford farmland yet, they're going to be looking at diamonds as diverse. You'll have many more people starting to diversify, and the more uncomfortable they get with American politics, the more demand's going to pick up for diamonds, and I do expect that to happen. So even for those right now that are just starting their education on diamonds, it's definitely worth spending time and learning, because I think sometime in the next several months, you're going to need to be buying diamonds unless it looks like Obama is not going to win. But certainly if he wins, I think you'll see diamonds go to some very high prices.
Yeah, Tom, and I think we're also ahead of the curve on this, just like we have been on many of the other things, and not patting ourselves on the back, but I mean, we know where things are heading. We understand where the things are going, and I think when it comes to something like diamonds, we're ahead of the curve, even though there has been a lot of money that's been flowing into these things. You've been selling these things since 1975, and based on all the research that I've been looking at, I'm beginning to say, you know what? This looks like it might be another mega trend coming, because no doubt the ability to, it's so portable. Airport security doesn't pick it up. It offers that asset protection. For those, Tom, who are thinking, I'd like to take some of my gold and hold it offshore, this might actually be a solution because they could actually take that money that they wanted to buy gold.
Oh, yes, I would agree. Yeah.
And just put it into diamonds. And
I agree.
In essence, be able to leave the country, in a heartbeat and take it with them. They're lightweight, and again, the most portable form of concentrated wealth that I think exists. So, in summary, and I do see we have a couple of questions I want to address, but let's just quickly summarize because we're almost out of time. In summary, holding physical metals is very important in our current modern era. Number 2, gold will perform very well, and we expect gold or silver to do even better. It doesn't necessarily mean that's where all your money should be. We just expect the returns to be amplified there, but also the risk to be amplified as well. And number 3, diamonds, for many of you probably a very new concept. Diamonds can make a great addition to your portfolio. However, keep your diamond exposure, very important, friends, to no more than 5 or 6% of your total portfolio. This is not something you just go put all your money into. This is something that would be a nice addition to your portfolio. 5 to 6% of your total portfolio would be appropriate for diamonds. Tom, that seems to be about the right amount for the portfolio.
It is, and a lot of my clients have been with me for many years. That's exactly where they try to keep it. I mean, I've got a few that like 2 or 3% and several that like 6 to 9% just because of the confidentiality of it. But the best number that I've always recommended is that 5 to 6% range.
Okay, and how do the taxes work on that, Tom, with diamonds?
Well, they're long-term capital gains, and they're not like the metals that have a higher rate. They are, normal rates on them when you sell them. So it's, but there is no reporting, there is no 1099, but certainly when you sell them, you do owe a tax, but there's no 1099 that goes to the government for those. I get that question a lot. So the answer is, yes, they are considered a capital gain when you sell them.
Okay. All right. Well, I want to let people know the question, obviously, how do you buy gold, silver, or diamonds? For those of you who are here for the very first time, or those of you who have already been with us, we make the process very simple. Tom, you make this very simple process. They simply call you. Here, I'm showing the slide here, how to buy in 5 easy steps. They call you, Tom, at 800-247-2812. Now, when they call you, Tom, will they be talking to a call center in India, or will they be talking to you directly?
Well, they'll be talking to either me or my daughter, and if they're talking about diamonds, they'll be talking to me because she just handles metals with me. But I take every call, and I feel if people are trying to invest and do it's my obligation to come to the phone and talk to them. That money they've worked hard for, and it's important to them, and it's just important to me that they get the right information. And as we've talked about many times, that's the reason I'm still working, not because I have to, but because I enjoy it, and I love helping people get their portfolios diversified.
Yeah, I think we're both in this for the same reason. We love to help people, and that's why we're doing this. Now, number 2, you decide whenever you call the 800 number, 800-247-2812. Perhaps you just have some questions you want to ask Tom about, whether diamonds, gold, silver, something you've heard on this webinar tonight. The next thing that happens is that you and Tom are going to discuss which hard assets are best for your particular situation. Maybe a little bit of diamonds, maybe all gold, maybe some silver. Who knows what it might be. And then once you decide upon that and you decide what you want to do, then you place your order and then you lock in the price. Do you lock in the price, Tom, on diamonds, or is it a different process there?
No, we lock in price on diamonds right there. Now, it's a little bit different from the standpoint someone says, I want to buy a $5,000 yellow diamond. There's 3 different grades we recommend for investment. So then I've got to check the source to see what the closest thing I can find to the budget that all the 4 C's fall into no deductions. We want to be sure we don't sell any diamonds that have any deductions. So sometimes it'll take me a day or two or three or four even to find the diamond. But it's not like the diamond, not like the gold market or silver market where the price changes every 15 seconds. Then we'll call back and say, we found the diamond and here's the parameters, and they say, yes, I want it, or no, keep looking for something else. So it's a little bit different, but it is done in a few days at the longest.
Okay, once you lock in your price and you mail in your funds to Tom's office, and then he ships out the precious metals or the diamonds, do the diamonds go shipped the same way, Tom?
Yes, they ship the same ways, no insurance. We pay the insurance and the shipping charges, and we send it registered, insured through the U.S. Postal Service, or depending on the value of it, we may FedEx it since we get higher insurance with FedEx than the Postal Service.
Okay, there are a couple of questions, and if anyone has any questions, now is the time to ask them because we're getting ready to close our program tonight. It's absolutely been an honor to have Tom here and all of you as well. We really do enjoy these webinars. First of all, we have a question from Matt. Good friend Matt there. Good to see you tonight, Matt. Matt asked the question to Tom, that certification that you were talking about on diamonds, is that recognized worldwide? That's the question.
Yeah, there's two major laboratories that are fairly well known worldwide. GIA is the premier grader of diamonds in the world. It is a United States company, but they've started offices all over the world. And if you're dealing in colored diamonds, I'm only going to recommend a GIA certificate, period, because it's recognized anywhere in the world. Without going into detail, there's also an EGL, which is European Gemological Laboratory, that are good for white diamonds, but you understand that grading standards are different between the GIA and EGL. And rather than spending 5 or 10 minutes going through those that are interested in knowing about that, I'm happy to take the time to teach you. But yes, a GIA diamond is recognized anywhere in the world.
Okay, hope that answers your question there, Matt. Also, Sherry has the question. We're going back now to the IRA. Please discuss how to cash the IRA out since they are in storage.
Okay, when you're ready to sell your IRA, you call me. You tell me how much you want to sell. Then I put a sale order in. Then you, the account holder, signs off that you agree on that. And then we lock the price in. And the next thing that happens is we will send a check to your custodian, whether it's Sterling Trust or Gold Star or Entrust. We deal with Entrust also. Then you tell them that you want a distribution, and they're the one that has to give you the money. What I work with you on is the liquidation of the metals back into your cash fund, and then you take the distribution, and they'll 1099 you at the end of the year for the distribution that you took. If you don't take a distribution, you just want to sell gold because you think it's ready to go down, then the money just goes into your money market there until you're ready to put it back into something else. And that way it's not a it's not a transaction. You're not going to take delivery. There's no taxable transaction. You're just selling it because you think it's gone up as much as it's going to go up.
Okay.
So that's how simple it is.
Okay, Tom. Also, David has a question. He says, what payment methods can we use to buy from Tom on the diamonds, gold, and silver?
Personal checks, cashier's checks, and money wires. We'll take money orders up to $10,000, and then we don't take cash and we don't take credit cards. No cash, no credit cards.
Okay. Hope that answers your question there, David. If there are any more questions, speak now or we'll certainly run out of time. Tom, really appreciate your time this evening. I know that it's late where you are. It's probably, it's getting pretty late where you are for sure. But I do appreciate your time tonight. And the folks can certainly look forward to hearing our latest market update again on the program this Saturday. Simply go to FTMDaily.com. Be sure to download or listen to our latest broadcast, our latest radio program. Also, if you are not currently receiving Tom's email alerts, you can do that. Simply go to our website, ftmdaily.com, and sign up. Just click on the Precious Metals button there near the top, and you can fill out the form. It's just basically your name and your email, and you'll be put on his list. We never sell our list or rent our list or anything, so whenever you go on there, it's private, and you'll be able to receive updates from him and buy and sell alerts. It's really good stuff. I would recommend that you get on there. And one more question here. Can you take physical possession of gold from an IRA? Is the question.
The answer is yes, and it's actually a very wise thing to do because the products that are allowed in an IRA is a very limited menu. Like they've got to be 24 karat gold coins or bars. The American Eagle is the only exemption to that. So all those coins bring a premium over spot when you sell them. So if you decided you want to take delivery the day that you tell them you want to take delivery, that is the spot price they will 1099 you for at the end of the year. So if you took delivery of, say, gold eagles or gold maple leaves that were in your IRA, and we could get you 1 to 2.5% over spot, by you taking delivery and then sell them in the market, then you're only going to be 1099 for the spot price. There have been many clients delivered the physical metal over the last 3 years during these interesting times. So yes, you can do that.
Okay, excellent. All right, well, we just have some people saying thank you, and obviously I'm very thankful too, Tom, for you taking time tonight. I know, again, it's late, and so thank you again. People can call you, 800-247-2812, free consultation with Tom Cloud about precious metals, any of the things we've talked about tonight. You really do yourself a favor by giving him a call with any questions that you might have. Tom, thank you for your time tonight. God bless you, my friend.
Thank you, Jerry. God bless y'all and the audience, and look forward to talking to you.
All right. Talk to you later. All right.
All right. Good night.
Good night. Well, friends, this has been Jerry Robinson and Tom Cloud on the FTM Daily webinar. We are so thankful that you tuned in, and be sure to visit our website for more information. God bless you.